Hi everyone, thanks for joining our webinar today, Current State of the Global Oil Market. We're just going to wait a few minutes for more people to log in. Hi everyone, my name's Amanda Lake. I'm a marketing specialist with the Genscape oil team. Thank you for joining our webinar, Current State of the Global Oil Market. Today's presenters include Dominic, founding partner of Energy Management Institute, Jody Quinnell, oil product manager at Genscape, and Hillary Stevenson, oil markets and business development analyst at Genscape. We encourage you to put all of your questions in the bottom of the box on your screen under the slides. You can ask questions at any time and we'll hold a live Q&A at the end of the webinar. So I'll hand it off to Dom.
Okay, thank you very much for having me and welcome to the changing world of oil. As we've seen just in the last 24, 36 hours, we may have the evolution of maybe a change, and I'll talk about that in a few minutes, but let's just go back and looking at the first slide and just describing how we got where we are. It's not real complicated. Inventories, total crude oil inventories in the United States, total global inventories, total Cushing inventories continue to rise, and what we see is a corresponding depreciation in the value of oil. We've had a tremendous decline in oil since the peak around June of 2014, and we are now sitting with record high inventories in many places around the world, including cargoes offshore. Just today, I saw several articles regarding floating storage of gasoline that's emerging around Europe right now. When we look at what's evolved since mid-June, we see oil prices are down by over $70 a barrel, primarily exacerbated by the Saudi Arabian led OPEC market share strategy, which started in November of 2014. And since then, what we see is, at least according to the latest from Wood Mackenzie, only 100,000 barrels a day decline in total global oil production, yet we've seen over a $70, almost $80 a barrel, depending on which crude you're looking at, decline in the value of oil, which strongly suggests that so far the market share strategy led by Saudi Arabia is not really working to their advantage. Yes, we've seen crude production coming down, and Jody will be talking more about that in detail in her section. We've seen a tremendous decline in rigs. We've seen U.S. domestic production leveling off, but still above almost 750,000 barrels a day above where it was when oil peaked out in June of 2014, and inventories anywhere from 30 to 35% higher, depending on which inventory parameter that we're looking at. And when we look at just one of the latest global supply and demand balances. This happens to be the one produced by the EIA about a week ago. Maybe there is a little bit of a light at the end of the tunnel, as we could see as we enter into 2016. Yes, everything is still surplus, but the surplus or the magnitude of the surplus is finally looking like it's going to mitigate on the premise that global oil demand forecasts remain in play, and then certainly supply doesn't increase precipitously. And again, I'll talk about that in a minute in regards to what's going on with OPEC and non-OPEC and their potential oil deal. But what we see is maybe the worst of the oversupply is behind us, and maybe we're now heading into a period of time where the world remains in a glut, but the glut may be starting to turn the corner, and maybe we're starting to see that in the way the markets are starting to trade a little bit. In the last 4 or 5 days, what we've seen is the market starting to discount some bearish information and kind of embracing a little bit of what's ever even remotely bullish. Just in the last 4 trading sessions, WTI is up by around $4 a barrel. Brent's up by about $4.50 a barrel. So we're starting to see some of the shorts moving into the sideline. And again, that's possibly the market starting to maybe get a little bit more confidence that maybe we're heading into a better period over the next 6 months to a year. That said, when we look at just the price of WTI over the last decade, or this decade, it certainly doesn't look very promising. We've made new lows compared to the lows we made during the financial crisis in 2008, and we still haven't really embarked on any kind of a sustainable uptrend. Since the market fell apart in June of 2014, we've had the largest run, the largest streak of monthly downturns that we've ever really had in the oil market. Even the downturns that we had during the financial crisis and the peaking in 2008 did not last nearly as long as this particular downturn is lasting. So it's messy out there, and it's going to take a long time for things clean up. It's going to take a long time before we see substantial, significant rises in oil, barring any kind of a major geopolitical event for that matter. So where do we go from now when we look at just a few questions? There are many questions that are floating around in the market, and when we look at some of the pertinent ones, at least in my mind, will global supply and demand rebalance itself in a reasonable period of time, just solely based on the low price environment? Well, the answer to that question is not quite. We haven't seen that rebalancing taking place yet. It's still down the road. It's still maybe not until we get into the end of 2016, early 2017. And the one thing that we know is that at $30 a barrel, we haven't seen any signs of an acceleration in the market rebalancing itself. So if this little bit of minor euphoria fades after this OPEC discussion of a deal, and the markets resume its downtrend, we may logically see the market continuing to look for a price level or threshold that might accelerate the rebalancing, and that might be something noticeably below 30. It could be 25. It could be as low as the $20 a barrel that Goldman Sachs predicted some months ago. But for now, we have to assume that the rebalancing period is going to occur, but it's going to be slow. It's going to take at least through 2016 and into 2017 before it happens. And if we don't have a production cut, how low can prices go? Well, certainly that's tough to predict, but it could go into the low 20s. I mean, there's no reason to stop it from going into the low 20s. It's going to be a direct function as to when inventories start declining or slow down the building process, and that'll ultimately work its way to us finally setting a bottom in this market. Certainly, what about the elevated geopolitical risk? There's a lot of geopolitical risk in the Middle East in particular. It's been there. It's been there for the last year, 2 years, 3 years, 4 years. When we look at the amount of oil that's shut in because of geopolitical events around the world, it's still substantial. The issue or the problem with a geopolitical push to the upside is there's just too much oil around. So yes, it's there. Yes, it could come back to having a significant impact on price if, in fact, it continues to persist and at a time when the surplus starts declining, which is certainly not yet. It's still more in the projection mode as to where it goes. And then certainly there's a lot of uncertainty in the global economies. China may not be growing as fast as originally thought. Japan is certainly looking really weak. We've had negative interest rates now in Japan. Europe is still struggling to work its way higher. The U.S. is still the bright spot of the global economies. The economy here is growing, certainly not as fast as we've been used to historically, but it's growing. Demand has increased for energy, but again, it's not going through the roof. So demand is still a precarious element out there from a global perspective. The IMF and World Bank just recently lowered their GDP projections for the global economy, and when you look at that and you look at some of the macroeconomic data that's been coming out around the world, including manufacturing data out of China and Europe, it's still looking like it may be a slow go before we see any major growth in global oil demand over and above the bump up we got in 2015, primarily due to lower oil prices. So that brings me to the main discussion item that's running around the markets for the last 48 hours. Started over the weekend, or actually late last week, and it resulted in a meeting on Sunday between Saudi Arabia, Venezuela, Qatar, and basically, and Russia, with the intention of there's some basis. Certainly, since the beginning of the year, there's been many talks and discussions about cutting production. Venezuela come up with an idea and saying, okay, how about freezing production? And that discussion got a little bit more interesting over the weekend when those countries I just mentioned agreed that they would freeze their production levels at January production levels if the rest of the people did. Today there was another meeting between Venezuela, Qatar, Iran, and Iraq, and that meeting ended with Iran saying, wow, this is a great idea, and we really support this, but they never did commit one way or the other whether they were going to freeze their production at January levels. And so the market is kind of viewing this thing with a lot of caution. Potentially it could result in additional steps. Potentially it could result in further agreements, and I think that's what's sending a bunch of the shorts to the market. But it's a deal that has a lot of potential holes in it, and it could make the market very skeptical in the next day or two or three. Even if Iran bought into the deal, will they cheat? They did a really good job of cheating around the sanctions during those periods. Will Russia really abide to the deal? If anyone remembers back in the late 90s when we had an OPEC, non-OPEC deal, and those countries, including Russia, agreed to cut production, Russia actually increased production. So whether or not Russia actually abides by any deal is certainly a huge question mark. So I think what we see right now is not a whole lot of new buyers coming into the market. I think what we see is some of the shorts exiting the market, and that's really what's promulgating the rally that we've seen over the last several days. And it's still too early to say whether this whole deal is going to garner any support, whether this is actually going to turn out to be a real deal, or whether it's just kind of going to go by the wayside, the way several other initiatives have gone over the last 6 months to a year. So when we sit back here and we look at where we are, where we're going, all we could say is we're still in a long-term downtrend. We're still susceptible to rounds of short covering rallies like we've seen over the last 4 or 5 days, like we've seen after we hit lows in January, middle of January, and that will continue to be the trend until proven wrong. And it's certainly not going to change without some sort of intervention in the short term. Only an intervention by OPEC, non-OPEC, cutting production is going to make a difference in the short term. Longer term, eventually the market will rebalance itself. Eventually we'll find the price that makes the market comfortable. That will accelerate that rebalancing period. But for now, we remain weak, and I turn it over to Jody, who can talk more about North American crude oil production.
Yeah, thank you very much, Dominic. So in this section of the presentation, we're going to cover North American crude production, talk about a little bit where we've been, and then more importantly, where we're going and what's going to happen. So just a brief agenda here, talk about the implications for crude oil production due to the lower prices. We've seen some dramatic cuts in Capex. Oil rigs have fallen dramatically, and really the economics of every key shale play across the U.S. are being challenged in this price environment. So what does that mean for production going forward? We are expecting year-over-year declines in 2016 and 2017. A lot of what's playing into that is the hyperbolic nature of the declines from existing shale plays. It's definitely impacting the base. It's taking more and more to replace those declines. We have seen efficiency gains happening, and they continue to happen, but not enough to really overcome those steep declines. So expecting production declines based on the activity that we're seeing right now and within this current pricing environment. So if we look at the Capex cuts, they continue to run very deep. We track over 150 different E&P companies as they come out with their Capex guidance information, and we collect all that information to compile it and compare it against prior years. So far, 26 companies have announced their 2016 Capex, and what you can see here is that for these 26 companies, when we compare it to 2015, down 25%, which is about a $41 billion cut in spending, on top of already what we saw was 23% from fiscal year 2014. So Capex cuts continue to happen, and we'll continue to follow these as we get more information and as they become public. And so what has this really meant for activity across the U.S.? Well, we don't think oil rigs yet have hit a bottom. We still feel that there's going to be about another 220 rig drop across the U.S., so bottoming out, and this is just oil rigs, bottoming out at around a little over 250 in August. We're currently at about 470 oil rigs operating across the U.S. So once really all this rig cutting happens and once we hit bottom, the U.S. will have lost 84% of the fleet compared to October 2014 at the peak. So significant drop in activity as a result of the cut in spending. As you can see, we do expect, after that bottom in August, that rigs start to come back just under 600 by the end of the forecast period as prices incentivize some producers to come back in the forward curve. Just looking at, across time, oil and horizontal rigs were at an all-time high in October 2014, again, come down significantly since then. We're now approaching levels that we haven't seen since the bottom in 2009. And really with, our forecast for where we're going, we are going to more or less touch those levels that we saw back in 2009. Across the plays, when you look at it, you can see that no one area, even the best areas, have been immune to the rig count drop. Permian has dropped the most outright rigs, but when you look at it on a percentage level, they're more or less pretty much the same from there. And then, this is a little bit of a messy slide here, so I'll try to explain it as best I can. But what I'm more or less trying to portray is that really, the Permian is one of the premier basins in the U.S., has some of the best economics. But at the current oil price, really no areas within the Permian are economic. So this is showing, across the bottom, the three major shale plays within the Permian Basin, and then each of those vertical lines are the individual operators within those plays, and then their corresponding break-even prices. The green line on here is a wellhead break-even price for those companies at 2015 costs, and then the red line on here is the wellhead break-even less a 20% reduction in cost. So that's assuming that we continue to see a reduction from 2015 in those costs. But even at those pricing, or even at those break-evens for those producers, the purple line on here at the bottom there is WTI March net a 350 differential, and what you can see is that none of those break-evens fall below that line. So really, the most premier play, the break-evens are just not working for these shale plays at the current time. So then the question comes into play of, why do we continue to see activity if none of these companies are break-even? Well, there's various reasons, why this may happen. Some are looking to maintain production levels, so they want to keep, a rig or two running to continue to maintain those production levels. Some have sufficient hedges in place, so they can bridge that gap from, the market price to their break-evens, and they're the lucky ones out there. And then others are drilling, uneconomic acreage at this time to reach held by production status. So even though, their break-evens might not be working right now, they want to hold that acreage so that if prices do come back, they can move back to those key areas. So really, what does this all mean for U.S. production? Well, production is declining. We've already seen it, and we're expecting it to continue to decline at this level of activity. So production peaked at 9.6 million barrels a day in April of 2014. It's come down to 9.2 million barrels a day. It's closing out 2015, so that's about a 400,000 barrel a day of decline. We're expecting production to bottom out at 7.8 million barrels a day by mid-2017, based on that rig forecast that I sent you, based on those Capex cuts that we've seen. All those sorts of things are playing into our crude oil production forecast and what we're expecting. It's about a 750,000 barrel a day year-over-year decline for really both 2016 and 2017 that we see coming. And then just looking at it, across the regions, where are we expecting some of the biggest year-over-year declines to come from? The Rockies, South Texas region will really lead the way. Some of the areas that will fare a little bit better is the Permian Basin and the Gulf of Mexico. Permian just being one of those premier basins, the economics are, even though I showed you that they weren't working out, they're a little bit better than some other areas across the U.S. The Gulf of Mexico really is ramping up because of projects that came online the end of 2014, beginning of 2015. We do feel that those projects will continue to ramp up. They were long-term decision projects, and then there's still some that are coming online in 2016. But then when you look at our outlook for 2017, we are expecting some more declines to happen in the Gulf of Mexico as it kind of catches up, and we have seen some projects cancel. Some of the infill drilling is starting to decrease, which is ultimately all going to play into that Gulf of Mexico forecast coming down in 2017 year over year. And then another thing, as I mentioned previously, is that the hyperbolic decline from the shale is impacting base declines. You can see from this chart, basically I have production for the years as it ramped up and then how it's declining going forward. And so you can see 2008, 2009, 2010, we didn't add nearly as amount of production, but we didn't have nearly as steep as declines as you look out the first year. Those years it was about 360,000 barrels of decline in the first year. Now we're looking at like 1.1 million barrels a day in the first year for 2014, which is almost 30-ish% that the base is declining. So that really, if you stop drilling at the peak, if you stop drilling in April and all drilling activity went away, production would end 2019 at 5.1 million barrels a day. So you'd see pretty significant declines if you just stop drilling altogether. Just to replace 2014 declines from this existing base, you would need to add, about 1.7 million barrels a day of additional production, and that's just to keep production flat. So at this level of activity, what we're seeing and what we're expecting, it's really hard to grow production at this level of activity, and why we're expecting, around 1.1, 1.2 million barrels a day of declines coming from the U.S. And then, one thing we can't, as we talk about North American production, one thing we can't leave out is Canadian supply and what's going on up there. This chart is showing our current forecast in the stacked area chart, and then our forecast from August of 2014, really before we started to see the price drops, the rig activity adjust to those price drops. What's happened is that the drop in prices has dramatically reduced our supply forecast, as it has worsened the economics in many of the conventional plays and some of the smaller non-commercial oil sands projects. However, with that being said, oil sands commercial developments are largely still going ahead as planned. Most of the industry budget reductions is to permits for production in the 3 to 5 year time frame. And really, we're still, as you can see, still expecting year-over-year growth for both 2016 and 17. So this will mute a little bit of, what we're seeing in the U.S. with regards to production declines, because more or less all this Canadian supply wants to come into the U.S. So it will push its way down here, which will, like I said, mute a little bit of those declines that we're seeing across the U.S. But, kind of just to wrap it up here, more or less, we are expecting production declines to come to really start to materialize here in 2016 and then continue on into 2017, based on the pricing environment that we're in right now, where the economics of a lot of these shale plays across the U.S. are just not working for the operators. So at this time, I'm going to go ahead and turn it over to Hillary, and she's going to talk a little bit more about downstream, what's going on with storage, and some supply chain dynamics.
Great, thanks, Jody. Yeah, I'm just going to wrap up with what we are seeing in terms of North American supply chain dynamics, storage, transportation, and a little bit of refining at the end. So I wanted to start with what is probably the most important part of the North American supply chain, Cushing, Oklahoma. The graph here is actually a slide from our February 2015 webinar, when the big question was, when will Cushing fill up? Genscape has been monitoring Cushing storage and connected pipeline transportation since 2009. We've observed historically that Cushing utilization is bounded between 20 and 80%. So given those bounds and the rate of storage that was building at the time, we had estimated that Cushing would reach operational maximum on April 17th, 2015. So that was a pretty good estimate because Cushing actually reached a record high on April 14th, 2015. So after it reached a record high in April, between April and October, about 10 million barrels were drained from the storage from Cushing, basically due to increased refinery demand, decreased production, location of the excess barrels from Cushing to the Gulf Coast. So then if we look towards the end of 2015, when end-of-year tax incentives incentivizes holding barrels in Oklahoma rather than Texas, that caused a new record high storage at Cushing at the beginning of January and then again on February 5th. However, about 10 million barrels of storage capacity has been added to Cushing since the last time we looked at this in 2015. So while we had high utilization in April, the storage highs in January and February of this year still had a lower utilization than we saw back in April 2015. All right, so here's another look at the backwardation to contango flip that we saw that sort of incentivized moving barrels to storage in Cushing in the middle of last year. So we first saw the flip from backwardation to contango in the 1-month spread, which gathered a snowball effect until maximums at Cushing were reached. We still see a reasonable contango in the 12-month spread, which is keeping Cushing storage levels high. So another thing we at Genscape always watch in terms of pricing impacts is the potential for Cushing to become bottlenecked again. Actually, in fact, the potential for Cushing to be bottlenecked right now is higher than it was in 2012 when there was a huge issue, in that now there's more incoming pipeline capacity than there is takeaway capacity. So despite the huge infrastructure build-out to de-bottleneck Cushing in 2013 and 2014, projects like Seaway, Trans-Canada Gulf Coast, and Seaway Twin, there's been a considerable build-out of incoming pipelines over that time frame too. Actually, in the last year, we've seen an additional 225,000 barrels per day of incoming capacity via White Cliffs, Pony Express, and the Magellan Scoop connection. However, there's not a huge immediate danger that we're going to have a bottleneck problem, as most of the incoming capacity is underutilized due to declining production, like Jody talked about. However, should domestic production increase in these areas, then we could have a bottleneck pipeline imbalance problem again. All right, so looking more into those pipeline transportation trends, the green line here is the into Cushing utilization. You can see it is here around 50–60%. And that equates to about 1.3 million barrels a day of unutilized incoming pipeline space. Then if you look at the blue line here, the Cushing to Gulf utilization, it tends to have a stronger impact on what's going on with Cushing storage. In the April to October 15 range, after the maximum was reached, Cushing to Gulf pipeline utilization was high, which helped move excess barrels from a constrained Cushing to areas of lower utilization on the Gulf. During that April to October range, we saw that inventories in PADD 2 and in Canada decreased 12 million barrels, and then in that same time frame, PADD 3 storage increased 11 million barrels. So there was definitely some shifting around of storage locations going on. Then at the end of the year, you can see there's a big drop in utilization of Cushing to Texas pipelines. That is again due to the end-of-year tax incentive to hold barrels in Cushing. Then you see once we go into 2016, there's an increase of moving barrels from Cushing to the Gulf. So just to take a little bit closer look at this end-of-year effect, if you look at EIA monthly data, historically Cushing inventories tend to increase from November to December, and PADD 3 inventories decrease from November to December. At Genscape, we've also began monitoring the domestic waterborne loadings. We noticed an increase in waterborne loadings out of the Gulf Coast at the end of the year, which also contributed to the decreasing storage inventories. All right, so back to storage and those interactions. The two lines on this graph show the EIA U.S. stocks and EIA PADD 3 stocks. And the bars represent record high storage levels at the different terminals that Genscape monitors. The first location to hit a maximum was actually Corpus Christi back in March 2015 due to high Eagle Ford production and decreased waterborne loadings. Then, of course, Cushing hit a maximum in April 2015. And as excess barrels were moved from Pad 2 in Canada to Pad 3, first we saw Beaumont Nederland storage hit a record high, followed by Houston, and then the rest of Pad 3 locations monitored by Genscape. With the end of the year, stocks began to pool in Oklahoma, causing another Cushing record high in January. And then just like the last Cushing high, the next location to reach a record high again was Beaumont Nederland. And then Cushing and Beaumont Nederland actually hit another record high on February 5th. And those two locations are linked via TransCanada's 700,000 barrel a day Gulf Coast or Market Link pipeline. So all of these record storage reports are not really the end of the world. We're seeing significant capacity growth in Pad 3. Beaumont, Nederland, Corpus Christi, Houston, Midland Basin, and St. James, the places that Genscape monitors. We're seeing about 20 to 25 million barrels of capacity in construction, with a third of that in the final testing phases. So more capacity will be online soon to absorb this, moving excess barrels from a constrained Cushing. On top of the tank construction, Fairway Energy Partners is building an underground cavern in Houston with an initial capacity of 11 million barrels. And that's projected to come online by the end of the year. EIA actually looked at their data earlier this week. They show that Pad 3 capacity has grown by 75 million barrels in the last 5 years. And Genscape data shows that they have added 10 million barrels since the last EIA report. So we should also consider the Brent WTI spread when we're looking at storage utilization. When I checked the curves on Monday, WTI was trading over Brent in 2018 through the end of 2017. And the reversal of that spread could see additional imports coming into the U.S., which would make the storage situation worse. So we've covered pipeline transportation and touched on waterborne transportation, so I wanted to take a quick look at what's happening in crude by rail. North Dakota crude by rail loadings and coastal unloadings, especially in the East Coast, have declined with the Brent WTI spread. The spread is a leading indicator of profitability of crude by rail in North Dakota. So on top of declining Brent WTI spread, there's also been a build out of refining and pipeline capacity in North Dakota that's also a headwind for crude by rail. In 2011, there was 400,000 barrels a day of refining and pipeline capacity in North Dakota. Now it's double that at 800,000 barrels a day, and then the North Dakota Pipeline Authority projects it could rise to 1.8 million barrels a day in 2020. So that is definitely bad news for crude by rail. At the East Coast, refiners have cut back in blocking crude by rail due to the availability of cheaper imported crudes. And then also some refiners there have announced that they're going to cut rates due to poor margins, also reducing the need for crude by rail. All right, so what's going to happen? Where do we go from here? If you look at storage utilization in the U.S., this is using EIA figures combined with Genscape capacity data, and then just Genscape monitored locations. Obviously, Pad 2 is a little biased to the high side because we have Cushing, Oklahoma in there. But U.S.-wide, we're looking at about 61% utilization, which is down from about 67% utilization back in April 2015. So definitely been helping out with to absorb all of the excess barrels. Pad 3 is the least utilized storage location. Cushing is essentially full. There is limited merchantable space, and it's near that 80% operational threshold. So since capacity is being expanded in Pad 3, and we know that the pipelines that are connected from Cushing to the Gulf Coast aren't full, there is a relief valve that can help move excess barrels south. All right, so we touched on that 80% operational utilization maximum. If we look at the rate, so if we consider the 80% maximum, and then we consider the rate of increases that we've seen in U.S. storage looking at the EIA data. Since August, we have been adding, on average, about 2 million barrels a week to U.S. stocks. So given that rate of increase, and then given the rate of increase that we've seen on the Gulf Coast, which is about 625,000 barrels a week, that figure is actually higher than if you did the same analysis using EIA capacity data. Between March and September 2015, EIA data indicates that capacity grew by 443,000 barrels. But we think that projects are being a little accelerated. So combining the rate of increase with the rate of capacity increase and considering 80% to be operationally full, we can see that we can withstand these kinds of builds for about another 4 to 5 months. So if all of that keeps tracking, we will hit a choke point around the middle of June. That's to say that everything else relatively stays the same. But one thing that could change is refinery utilization. Just to look back at 2015, the largest impact of planned maintenance was actually in the U.S. Mid-Con, despite having a much larger refining capacity on the Gulf Coast. Many Gulf Coast refiners had done really big turnaround projects at the beginning of 2015, so that left just a few isolated CDU and FCC turnarounds for the fall of 2015. Mid-Con refiners like in Catlettsburg, Coffeyville, Joliet, Wood River, Tulsa, they all completed maintenance on units with a combined capacity of 700,000 barrels a day. Looking forward into 2016, like we talked about with the rail, some refiners have announced rate cuts due to poor margins, totaling a little less than 2 hours a day. But like Jody talked about, U.S. production is projected to decline, and so production cuts could help balance out the rate cuts due to poor refining margins. So I guess in conclusion, in 2015, we've seen really strong dynamics between Cushing and the Gulf Coast with storage and transportation. Increased domestic production could cause future Cushing bottlenecks, but capacity expansion is helping us stay afloat in a sea of crude. And I will hand it over to Amanda for Q&A.
Thank you, everybody. Be sure to register for Genscape's Energy Forums event coming up in April. That's April 21 to 22 in Chicago. If you use the discount code Global Oil right now, you'll save $100 on your registration and also get 3 free hotel nights. Dominic will be there giving practical workshops and hands-on applications for how to use Genscape data. So be sure to register and let us know if you have any questions on that. Now we'll begin the Q&A, so please submit any questions if you haven't already. This first question is for Dominic. Is there a major danger in markets getting too bullish before an actual balance has been reached, prolonging the depressed oil prices?
Oh, certainly that's always the case. Markets have a tendency, it's a good question. Markets have a tendency to always overtrade an event. But I think we've had such a tremendous move to the downside, and even though we're at lower levels, it has some similarities to 2008 downturn. And if you recall, the market started trading higher from early 2009 on the perception that supply and demand was going to become balanced. And by the end of the year, for example, gasoline prices had doubled, crude was up significantly, and a lot of that was on anticipation. So we may be entering this perception of the market improving, and it'll continue, or it could continue, to move higher as long as each time we get a reality check vis-a-vis weekly inventories, monthly forecasts by the various analysts and the EIA tend to support that view. So if it doesn't, then we get these jumps and starts like we've seen over the last year. So it's too early to say whether or not we're at that stage yet. The market in the very short term is starting to look like it wants to be in that perception stage. I'm not sure there's enough support to maintain it at this level.
Okay, this next question's for Dominic as well. What is the actual oil price today if we take in consideration inflation adjusted regarding the value of the dollar of the year 2000 and the year 1990? Do you take in consideration the value of the dollar when you compare the price of oil?
Those are all very good questions. Unfortunately, I don't have those numbers on the top of my head. Certainly, the stronger dollar over the last 6 months or so has eased some of the pain and hardship for those countries selling their oil in dollar-denominated currencies. But I certainly will provide that answer in detail when we do the write-up of the questions, and I can actually give you the actual numbers.
Okay, this next question is for Jody. With peak production for U.S. in April 2015 at 9.6 barrels per day, and December expected to be about 9.2 million barrels, what are your expectations for shale decline rates and rig decline rates? When do you expect to see U.S. production truly start to decline in earnest?
Yeah, so great question. I think we're going to start to see production declines happen pretty significantly starting now. We think we're at about 9 million barrels a day currently and going to, 8.4 million barrels a day by August. So that's some pretty substantial declines that are coming really over the next 6 months-ish. So, we think those will really start to materialize.
Thank you. This next question's for Hillary. Is 80% a rule of thumb or a proven limit?
So the 80% number comes from our analysis of Cushing. We have never seen Cushing go above 80% utilization. And Cushing is kind of a good sample set because it has both merchantable storage and operational storage. Obviously, you can't fill U.S. crude to 100%. You have to have space for different kinds of crude grades, blending, pipeline receipts and deliveries. And so we think that Cushing is a good sample for those kinds of different mix of purposes. Obviously, some operators have merchantable storage and can fill to much higher than 80%. But yeah, that's where the assumption comes from.
Thank you. This next question is for Dominic. Dom, you said that it will take some time for the price of oil to rise significantly. What kind of time frame are you talking about here, and what kind of geopolitical event would accelerate this price increase?
I think to rise significantly, meaning $80, $90, $100 a barrel, I think it could be years in the making before that's going to happen. To rise to levels that may make shale a little bit more interesting and get some of these producers out of the hole, that can conceivably happen over the next year or so if, in fact, a lot of the projections that the surplus is going to start declining will certainly go a long way towards that. What was the second part of the question?
It was about what kind of geopolitical event could
well,
cause
certainly,
that.
That's a good question. I mean, certainly anything that results in any kind of substantial decline in a production that's actually coming out of the Middle East in particular right now. Certainly there's all kinds of proxy wars going on between Iran, Saudi Arabia. There's activity in Yemen. There's activity in Syria, certainly in northern Iraq. And all of these areas are in and around a major and a substantial area where oil is flowing. And if any of those events fall over, impact onto the southern portion of Iraq where the majority of its oil is being exported, or if it impacts any of the supply coming out of Saudi Arabia, certainly those would be significant events that would certainly clean up the surplus very quickly and certainly would result in significantly higher prices.
Thank you. Another question for Dominic. How will continued Venezuelan hyperinflation affect how long any OPEC deal could last?
Well, I mean, I think I'm not sure if it impacts how long a deal can last. I think it's motivating even in trying to get a deal. I mean, Venezuela has been relentless over the last 6 months in trying to convince anybody that's willing to meet with them and listen to them to get back to some sort of a price protection strategy. And I think as the financial issues in Venezuela continues to evolve to the point where they could be defaulting and the point where they're running out of dollars, I think that certainly motivates Venezuela to work even harder to try to get some sort of an agreement. So I think to some extent, I believe it increases a little bit the likelihood of a deal because as Venezuela goes, we also see other OPEC countries. Just today, for example, S&P just lowered the rating on Saudi Arabia, and certainly a lot of countries are hurting, and I think Venezuela is leading the list of them, but I think they're also leading the role in trying to get other nations to join them in doing something to protect the price.
Thanks, Dominic. Hillary, this is for you. You mentioned that Genscape is projecting a U.S. storage choke point in June 2016. When do you project a Cushing-specific choke point, or are we already there?
Sure. So the June date is just assuming that we continue to see builds in U.S. storage, either due to imports, but obviously that doesn't take into account any of the production declines that Jody talked about. That's just a assessment on the rate that we've seen since August. On the Cushing side of things, I mean, Cushing is operationally full. Our friends at RBN actually reported that they had heard that people were turning away storage requests for specific types of grades. Given that Cushing is operationally full, there is still empty capacity on pipelines to move excess barrels to the Gulf Coast. I think it's like 550,000 barrels a day of excess space to move barrels in and out of Cushing. So barrels aren't trapped there, but there isn't a lot of excess space to store crude there right now.
Thanks, Hillary. This question's for Jody. How do you come up with your rig count forecast?
Yeah, so our rig count forecast is based on the WTI forward curve. So we use that as an input into the model, which we then look at the economics that I showed you by the various companies of the plays. And really in that price environment, what is the capacity for rigs in that particular location based on those rig economics? So it's done at a very granular level, looking at the basins, looking at the plays, and then it's aggregated up into a total U.S. Outlook as well.
Okay, and another one for Jody. Where do you think current production is, and where will it be in August 2016?
Yeah, so, we think production is about at 9 million barrels a day right now. We closed out the end of 2015 at about 9.1, and then we're expecting to go to around 8.4 million barrels a day by August. So, like I was saying before, we feel that production declines are going to escalate. Production was kept, held up a little bit through, 2015 more or less, due to some efficiency gains, kind of that lag between a price signal and a rig impact and things like that. But now that we're, at levels of rigs that are expected to go to just 250 oil rigs operating across the U.S. from, 1,700 the end of 2014, we really do think that the impact of lower rig activity is going to start to kick in and have a pretty significant impact on production declines as we move through 2016.
Thanks, Jody. This question's for Dominic. Why would Iran freeze its production?
I don't think they would. I don't think they will. I think Iran, walked out. If Iran was going to freeze its production, they would have said so today when they came out of the meeting. Basically, what they said is it's a great idea, and OPEC and non-OPEC should work together, and they should freeze their production. And we think it's a great idea, and they should do whatever else they can do. But basically, they kept referring to everybody else. And at the end of the day, I don't think they have any intention of freezing their production. And I think they believe that it's their right not to freeze production since they've had their production suppressed for the last 3 years or so under the sanction regime. So I just don't see it happening at all. I don't even expect them to agree to any kind of an imposed limit as to how much they can increase it. I think they're going to do whatever they can do to get production back to the level it was at before the sanctions. And I think when they get to that level, then I think if this freezing type thing is still in vogue, then I think that they would then agree to it. It's basically, Saudi Arabia, Russia, those two in particular, agree to freeze their production, and both of their productions in January were at, Russia was at a record high rate, and Saudi Arabia was just below their record high rate from December. There's not a lot of motivation for Iran at their situation right now to even consider freezing production.
Thanks, Dominic. Another question for you. Given that the Saudis have an average break-even price that is sustainable near $10 a barrel, what incentive would they have not to flood the oil market, forcing the U.S. to sever domestic production to near historic lows?
I think from an oil in the ground cost, I don't think they have a lot of motivation not to continue on their market share strategy. From a financial situation for the overall country, again, their bond rating was lowered, their equity markets are down, their economy is certainly not booming. At some point in time down the road, the Saudi government may consider the fact that this exercise may not be taking them where they want them to ultimately be. Especially when you take into consideration at some point in time, as prices do recover and the economics of producing shale become interesting again in the United States, production is going to go up. So whatever happens insofar as production declines in the United States, at least in my view and understanding, is really going to be temporary. As prices go up, that oil is going to flow again. So I think this whole Saudi strategy, to me, again, is a little bit precarious on Saudi's part, but I don't think they're going to change it directly without losing a whole lot of face. And maybe it's I've been thinking about maybe this whole concept of freezing production is a very, very nice face-saving way for the Saudis to say that the market share strategy is not working, but no, we didn't cut production, but we're doing something. So maybe this is the beginning of some evolutionary change that might happen in that strategy.
Thanks, Dominic. This question's for Hillary. Crude storage and RBOB storage in PADD 2 are historically high. Do you see operational issue in the next 45 days?
So I don't have information on RBOB, but looking at crude storage, everywhere crude storage is historically high. But looking at other places like Patoka, other than Cushing, I think there's plenty of room, given new construction projects, that we shouldn't see any operational constraints in the next 45 days, plus the connectivity to move barrels to other places should there be an operational constraint. I think it should be okay.
Okay, another question for Dominic. What is your assessment of OPEC's spare capacity? Okay, we must have lost Dominic there, but I think we will go ahead and wrap up for today. I know we haven't answered all of your questions, but we will answer them in a Q&A document, so please look out for that later. We'll be sending the slides and recording from today's presentation tomorrow, so also look out for that, and be sure to register for Genscape Energy Forums in Chicago. Don't forget to use the code on the screen here now, and let us know if you have any questions. Thank you all so much.